Well, greetings everyone, and welcome to the March 2018 edition of the Roundtable. I'm joined here tonight by three very good friends: Kim Butcher from Indiana by way of Florida, Ken Kavula of the Mid-Michigan area and known nationally as an instructor. All three of these guys are national instructors for better investing, and Hugh McManus, who I believe is joining us from Southern California tonight, and he's somehow escaped Switzerland or Spain or New Jersey or all those places that he's jet setting around to. He's able to make it here tonight, and he's here to be supported. Welcome back, Hugh.
Thanks.
All right, so tonight we're gonna hit our traditional stock picks, but we do want to spend a little bit of time on this notion of we've seen this movie before, and it is a rerun, and the volatility and stuff we're experiencing is not really all that unusual historically. It needs to be placed in context. Doesn't mean it's easy, but this community, as Kim was saying just a few minutes ago, this community knows that this type of volatility can actually present shopping opportunities, so we want to keep that in mind. Applied Materials is on the slide because I thought about Applied Materials, but did not choose that as my stock tonight, but it actually looks pretty good. If you've been following Applied Materials, it actually shows up with a pretty good return forecast, a very high quality rating, and I would highly recommend, if you're studying the company or thinking about it for yourself or for your club, go to the investor relations page and take a look at their most recent presentations, their dog and pony show, where they lay out the strategy and they talk about the fact that Applied Materials is becoming more and more embedded in artificial intelligence and those type of major theme areas, and it's quite good. And we'll also talk about the final four tonight being our four selections by our three Knights and Damsels. So let's go ahead and get underway. Anything to add, Ken or Kim or Hugh?
No, tally ho. Let's get a move on it here. Here we go.
Let's go ahead and say everybody here knows that no investment recommendation whatsoever is intended by what we do. What we do is to demonstrate the philosophy and the techniques, the methods that we use in the modern investment club movement by either NEIC Better Investing or Manifest Investing. Everything we do here is for illustration and basically the power of demonstration. We may own some of the companies we talk about, and we generally disclose that when we do. But again, do your own homework. This is all about education and demonstration. Here's our agenda for tonight. It's basically a standing agenda. First of all, we'll kick things off, but welcome to all of you. We're coming down on Easter, so everybody get out there and find your Easter eggs. Big extra welcome for anybody that may be here for the first time or listening in on the recording. We put the recordings on YouTube, so you can catch them after the fact or share them with friends and family. But again, we just want to welcome the newcomers. When we get to the point where it says down there, point number 8, audience poll, everyone is invited to cast a vote. We'll spend a little bit of time talking about the performance of the picks that we've made over the last approximate 8 years. We don't have many challenges. We've been doing a lot of spring cleaning, a lot of house cleaning over the last several months, and we've culled a lot of the weaker return forecasts, weaker quality ratings from the portfolio. So we really only have ResMed. That doesn't stand for required minimum distribution, as many of us know about this time of year. Here's our 4 picks. Ken will do Western Alliance. That's a bank, Midwestern bank. Kim is going to take on McKesson. That's a repeat selection that we've had a couple of times. I'm going to go with Acuity Brands, ticker symbol AYI. And Hugh, being the stubborn Irishman that he is going to bring back General Electric. And we look forward to hearing his thoughts on General Electric. And I'm going to propose that we hold off a little bit on our discussion of the tax law turbulence and challenges that we see coming from that and the stock market volatility until after the audience poll, and that'll lead us right into an open Q&A. We generally stick around and take care of questions until the audience is satisfied. About an hour and a half from now. This is about a demonstration. We try to bring some of our best ideas, can in some cases be our single favorite investment opportunity. We keep track of how we do. We want to beat the market by 5 percentage points. And we'd also like to see the majority of our picks conform to the rule of five, basically with 3 or 4 picks out of every 5 outperforming the market from the time of selection. And as we talked about last month, I did mess up and missed a moment of celebration by leaving out some transactions. So there's missing some cash flow in our rate of return calculations, but we actually have a 6.4% outperformance, excess relative return compared to the Wilshire 5000 over these last 7 and 2/3 years. So you're looking at we kind of hit our stride after that 3rd year, and the actual absolute rate of return on an annualized basis is 17.4%. That means the market's gone up 11% with mirroring investments in the Wilshire 5000. But again, a big cyber high five. We're hovering around above that dotted line, which is the objective, and it's a stretch objective for all investment clubs to beat the market by 5 percentage points. That's 500 basis points, 5 percentage points over the long term. And we're there. And some pretty good stuff there. Any comments or questions?
I just feel real pleased that we can demonstrate that the methods that we've been talking about for so many years actually do work. I belong to 4 different investment clubs, and one of them is sitting right on the market averages within 1/10 of a point, and the other 3 are beating the market by one of them by 2 points, one of them by 4.5 points, and one of them by 5.5 points. So what we're doing does make a difference, and this long-term event horizon that we're kind of keeping in our vision into the future really does help us put together portfolios that can do at least as well as the overall market, and in many cases, if you pay attention and do your homework, it can beat them.
Yeah, we'll probably spend some time in the coming month quantifying how special or how powerful that performance is, but a 17.4% return over the last approximate 8 years is pretty cool, in a word.
I think another thing that's interesting is that when a position is sold, those funds are not, quote unquote, reinvested back into the portfolio.
No, they're treated as a positive cash flow out. So we'll actually show a little bit of that information too. So we bank it. It's pretty cool to watch. And in fact, we could get to a point someday where we have several $100,000 and our net cash inflow into the round table portfolio is close to zero. That's kind of the point where it's just wild when you see that happen. Not unlike, and not to belabor the point, but Tom O'Hara's 50 years in the Mutual Club of Detroit, his total investment was $16,000, and his investment club balance, his own account, was $1.5 million. It's just amazing to watch when you see that actually work over time.
Yeah.
So here's the companies that we have ridden to this point. There's a few that we've actually, as we were saying, sold off and took the money and ran. Like companies like Walgreens was fairly spectacular. Southwest Airlines, there's been a number, but these are the ones that are currently in the portfolio. They're listed from the largest positions in terms of percent of total assets, or they're ranked by value. This is the top 20. So the Cognizant Technology has the most influence on the portfolio. The legend up at the top gives you how many times each one has been made or decided upon. So we've actually had either a knight or a damsel or the audience select Cognizant Technology 12 times. Priceline or Booking, as it's known now, BKNG 10 times, CVS 10 times. So you can look down that list. There is one on here, and we'd like to point it out almost every month. NetEase is a one-time selection. $1,000 invested in NetEase down here at the bottom is worth nearly $6,000 today. So that's good, clean fun when you can come up with one of those too.
Mark, I'm interested. Global Payments just has nudged itself onto the list. I think that's another one-time pick, isn't it, Global Payments?
I think it is. So we're going to have to celebrate that one too. I don't see it listed on that. I actually did an audit and a pretty thorough cleaning of that legend. So that probably is also a one-time selection. And it was either Ken or Cy Lynch that made that one years ago. Do you happen to remember, Ken?
Yeah, it's one of my very, very early picks,
Okay.
extremely early picks.
There he
Yeah.
is, audience, rubbing it in again. And
Yeah.
Nettie's is probably yours too, right?
I don't know about NetEase.
Yes, I follows
A
it too.
couple of us have talked about NetEase. You would have to go back into the records and look at that one.
There's a number of pretty powerful performers on there. Since Hugh's here, we'll brag about Hugh's selection of Amazon. I believe that's a two-time selection. I think it is. Two-time selection of Amazon is now worth
Yeah.
10,000. And many of you in the audience out there tonight were also there when he made the selection at the national convention in Chicago, and nobody voted for it. And it actually was the best performing selection over the next 1 or 2 years, and it still is just zooming along pretty well. Again, a $2,000 investment in Amazon is now over 10K. And Kim, what do you have any special highlights on? Well, I see one. There's actually a couple here.
I see three.
There's Kim, a couple
They're
of
all
Kim.
together. PayPal,
Oh, and
LGIH Homes, and S&P Global.
yeah, those are all zooming along pretty good. So again, these are the stocks that actually account for the majority of the performance. If you're out there in the audience and you'd like to see the entire list of the active tracking portfolio, you can go to that link up at the top. It is a public link. You don't have to be a subscriber, but if you are a subscriber, you can do more stuff. So let's go ahead and talk about companies which could be on the hot seat. And like I said, we've been cleaning this thing out for the last several months. The only company that comes fairly close that has a relatively low return forecast, and it's not low, is ResMed, checking in at about 5%. Very high quality company. We're certainly in no hurry to sell. The average stock now has actually edged up to 7 or 8%, as is shown there in that longer term return. You can see that this last break in the market, the correction, has actually resulted in the return forecast going up, stock prices going down. So we've kind of returned to fairly normal levels. I don't believe that the stock market is, whatever the stock market is dramatically oversold at these levels. And the correction has been quite firm. Ken or Hugh or Kim, any comments on?
Well, I think we should just put things in perspective, Mark. That my par number up in the upper right-hand corner, that's the average return for the mid-placed stock in the entire database. And over history, that number has been up around 9, 10, 10.5%. For the entire stock market. The average return, depending on how you measure it, for the stock market's been 9 or 10%. So we're moving back towards what has been historically average going into the future. So I'm not especially concerned or worried right now. I like our portfolio averages better than I've liked them in the last maybe 8 or 10 months. Our par is moving. It's 4.5 points above my par. It's moving to that 5-point number that we'd like it to be. And we've pushed our growth back above 9% again. For a while, it kind of hovered at 9.5%. And now we're at 10.8, moving towards the goal of around 11.5. So I think we're in nice shape as far as this particular set of numbers is concerned. I would like to see us begin to do some audit on quality. Remember, we've been doing some work on kind of checking out when quality deteriorates and asking ourselves if that stock still belongs in the tracking portfolio. So as we move those out, what's left, the numbers are becoming much more to my liking. I'm very pleased with this report card this month.
Yeah, I think we're in pretty good position, and the performance has been strong over the last couple of years. So we'll just keep pressing on. We'll probably spend a little bit more time on the quality decline theory that we've talked about. Just a quick look at ResMed. It's been in the portfolio for quite a while. I think Ken first presented it years ago. Definitely an up straight parallel type situation. Fairly high quality company. Pretty consistent. Talking about upper single digit growth rate, 20% profit margins, net profit margins, PEs in the low 20s, and returns in the mid single digits. There's nothing wrong with this picture, and I don't see any reason to rush off and sell it. The portfolio doesn't really need it, so I think we'll just table it for now. And with that, I suggest we just go ahead and kick off Western Alliance Bank Corp. I'll just, again, Ken's going to take this one live and show us a few things, but in Warren Buffett's letter to his shareholders, you can actually see that he lays out Berkshire Hathaway. The very first page of his letter to his shareholders is this graph. It takes a look at the book value of Berkshire Hathaway over time. So what we're looking at here is the book value of Western Alliance Bancorp. Certainly an upstraight and parallel situation with a decent outlook. And like I say, that it's a good way to look at the asset-based companies like the banks.
Mark, I would like to address one question before I move to the Western Alliance presentation. John says, how do you treat dividends when you're dealing with all of the numbers that you put together? And the prices are adjusted for dividends, so they are included in the returns that we're talking about. When you see that outperform that 17% annualized number, that does include dividends. We're not just looking at stock price appreciation. So it's a pretty true internal rate of return that we're calculating when we're dealing with all the things that go into the total value of the portfolio. I'm going to take this live, Mark. If you can, or here I can do it. I'll send the screen to myself here. Just give me 1 second. Here we go. And I'm going to go live. I don't do this extremely often, except I really wanted to show you how easy it was to find some of the things that I'm looking for. I decided after all the new Fed chair and the increase in interest rates again, and we've been talking. If you listen to the analysts that are supposed to know something, they say that we're in an environment that is supposed to be very favorable for banks as interest rates continue to rise and as we start unwinding from the quantitative easing that's been going on. So I decided about 3 months ago that it was time to look for some banks to put into a couple of the portfolios that I manage. Up until about 3 months ago, I only owned a single bank. I'll talk about what that bank was a little bit later. But I started doing some research trying to find banks that I thought were fairly conservative, had business models that I could understand. And then I used some of the new tools coming from Better Investing to help me understand how the bank was actually doing. I stumbled across this list right here, America's Best Banks in 2018. This is on a free site from Forbes magazine. They're ranking the top 100 banks by assets, and then they're putting them on an ordered list from what they consider best to worst. If you're trying to figure out what exactly the rationale is and what they're using for the benchmarks for this ranking, they do a pretty nice job of explaining it. And about halfway down the article, you can see that you can click right here, if I can get my mouse to hold, right here, and you can call up the list itself of the 100 largest banks, and it's listed. The author of the study is this Kim Badenhausen, and he works for Forbes magazine. He's an analyst and a writer, a journalist for Forbes magazine. So here we are with the first 8 or 9 banks on the list, and I was surprised that I only knew the name of 2 of the top 5 banks. I had never heard of Home Bank Shares, Western Alliance Bancorp, or First Merchants Bank. I had heard of Bank of the Ozarks. In fact, it was the only bank that I had owned and still own in my portfolio. And I belonged to a club that for a long time held on to East West Bancorp until the financial crisis, when we moved that bank out of our portfolio and haven't looked back on it since. But the top 5 banks, I decided I would submit to some studies and see what I could find out. So the first thing I did was I put them on a manifest dashboard just to see what the quality looked like and just to see what the par values look like. Here's those 5 banks on the dashboard, and you see that First Merchants Bank came up with no numbers. That's because we didn't have it in the database. We don't include all of the companies that trade in the database, but when we find a company that we think has merit, we do the study. Mark puts the numbers together, excuse me, and then it does appear. So First Merchants is going to appear with a full set of numbers in the next update. That should happen in the next 3 or 4 days. And meanwhile, I'm looking at the other 4 banks that are on that list, ranked 1, 2, 3, 4. 5, and I noticed that the highest quality of the group is this Western Alliance Bank shares. Again, a bank I had never ever heard of, and on top of that, it had a kind of an enticing par value attached to it. When I started studying Western Alliance, the par value was somewhere around 11%. The par value has gone up a little bit because the price has actually dropped a little bit since I first began studying this particular bank. So Western Alliance was the one I focused on. It's the one in second place on that list. So I skipped over Home Bank Shares, Bank of the Ozarks, East West, and First Merchants, and I begin focusing on WAL, Western Alliance Bank Shares. So I went to the new SSG Plus tool in Better Investing. And if you notice, when you're looking at this tool in Better Investing, you see that there aren't just 3 fields attached to this graph. There are 4 fields attached to the graph, and there aren't just 3 measures of management quality, but there are 4 measures of management quality. This 4th line will suddenly appear on any SSG that is studying a company that's in one of the Morningstar classifications that includes the word bank. So Midwest banks, regional banks, money center banks. If the word bank is in the industry title, then we're getting this 4th line in our new tool to help us decide what's really good and what's really not. Now, I know this legend is hard to read, but I'm clicking at the very bottom of the legend because I also have a new line on the legend that wasn't there with any other non-bank company, and that's assets. That's exactly what Mark was talking about. We happen to have a bank examiner, Ross Meredith, from the Rocky Mountain chapter, lives out in Salt Lake City, Utah. And Ross is a former bank examiner, as I said, and he helped us decide what was important for us to look at when we started looking at banks. And whether you're measuring book value, that graph that Mark showed you was a graph of book value, or whether you're measuring, and here's the graph of book value, that's the black line that just appeared, or whether you're measuring total assets, that's that kind of aqua line right under the green line here that's appeared. You're looking for good, solid, consistent growth in those 2 things, and ideally, you'd like those lines to be parallel to the earnings line and to the sales line. In other words, if you can have 5 lines on this graph and they're all up straight and reasonably parallel, you're beginning your study with a bank that meets the first hurdle. It looks like it's high quality. What you then do is you move to the numbers. If you can't read these slopes, and just by looking at them, the parallel nature says that the numbers are reasonably consistent. Here are the numbers that lie behind these 4 lines, not the book value, which I'm going to take off of the graph for a moment here. But here are the numbers that lie behind these lines. And if you look at their values, you'll see that the values cluster very tightly. The same values result in graphs with the same general slopes attached to them. So those are all good things pointing to a high quality bank. The next thing we look for is how the bank makes money moving into the future. And a good measure of that is return on average assets, ROAA. And that's what this last line under management is actually calculating for us. It's showing us the return on average assets. And in order to know whether you have a good bank or not, you have to know what's a good number. An average bank has a return on average assets of somewhere around 0.8, 0.85. A good bank has a return on average assets somewhere around 1.25. And a superb bank, a really high quality bank, has a return on average assets somewhere around 1.5 or better. Those are percentage points. The numbers might seem low, but when you can return better than 1.5 on your average amount of assets on a year in, year out basis, then you have a really high functioning bank. Again, you don't want to isolate these numbers just individually. You want to kind of take a look at a 2 or 3 or 4 year period, and I'm choosing the most recent 4-year period. In fact, I can actually choose the most recent 3-year period, where Western Alliance went from being a very good bank to being a superb bank as measured by the return on average assets. And you can see the 5-year average has stayed above that 1.5 number that we're extremely interested in. I'm going to turn the SSG over. I'm looking at fairly tightly clustered PE values on this traditional SSG, and I'm looking at a PE today of a little bit less than 19 compared to an average PE of a little bit less than 16. The bank, because of its growth, is increasing its PE. If you look carefully, you'll notice a general upward trend in these numbers. It's not ideal, it's not perfect, but generally the numbers are moving up, and the same thing's true here. Generally, they're moving in an upward direction. That means that the PE for this high growing bank is expanding. That's a good thing to have happen. When I put fairly conservative numbers into this bank, which does not at the present time pay a dividend, I'm getting a good solid buy, and I'm getting about 12.8% par. If you remember from the dashboard I showed you, the manifest number being generated from the analysts is just about that same value, somewhere around 12% as well. That gives some validation to my study. It makes me believe that I'm on the right track, and I'm looking at the right numbers and analyzing them in a way that that makes some sense going forward. Just a little bit about the location of the bank and what it does. The bank has its home office in Arizona, in Phoenix, Arizona, and most of its branches are centered in northern Arizona, southern Nevada, and that crook in the state of California. So it's kind of overlying that general area in 3 states. They do have a few branches on the East Coast, and they have 1 or 2 branches in Texas. They operate under 3 or 4 different brand names, and there is a pretty good presentation on their website if you want to go to their website and see where they are. They seem to have some niche markets that they're really operating in. They do a lot of funding for office buildings and for commercial structures. They have extremely low loan loss characteristics, and that's another measure of a high quality bank. If you take their loan loss provisions and divide it by the total loans outstanding, and if you get a number consistently under 1%, there's another indicator then of a nice high quality bank for you to perhaps take a gander at. So with all these things that I've put together for this particular bank, I'm feeling pretty good about recommending that we put a position in Western Alliance Bank Shares, WAL, into the tracking portfolio. I'm re-quoting Hugh from the very first Let's Talk Stock that we did at convention about 10 or 12 years ago, when he got to the microphone and he said, I want to own a bank. Well, that's exactly what I want to own today, is a bank, and I'm going to suggest we put Western Alliance into the portfolio. Thanks, Mark.
Thank you, Ken. And he, by the way, he followed up with Bank of America shortly thereafter that.
Yeah. Been doing quite well.
Yeah, it's done pretty well for you. You want to switch back to me, Ken?
It's on the way.
Okay, show the screen. And we will move on with, again, thanks, Ken, and we will add the bank accordingly. And let's go ahead and move to Kim. Kim worked in the healthcare industry, so she's got some insider knowledge here. But let's talk about McKesson. It's a repeat selection, and take it away, Kim.
Yeah, McKesson, as it says on the screen there, is one of the oldest and largest healthcare companies in the nation. Serves 50% of the hospitals, 20% of the physicians, and they get 1/3 of the medicines used daily in North America to everybody. And we had McKesson in the hospital everywhere. So you can see it's nice and steady eddy, kind of nice there and straight. So next slide. This is the this is the value line here. Mark, and can you circle the projections box for me?
Sure.
One of the things that I personally like to have is in the projections box, I have to have usually, I mean, in my little checklist, these are certain things I always want. And in this case, I like to have a low of 10% annual return. So I have this because it's saying we're going to have at least a 17%. The stock price, this was from the value line, which was February the 16th. At that time, the price was 152. And as this says, the price closed today at 138.75. And if you look up above, at that time, the PE ratio was 11. And the trailing PE had been 12 and the medium 15. And if I can ever find a PE ratio that is below its medium and its trailing, I'm happy. I sometimes will search for a stock by wanting to see if I can find a PE of 10. Also, Mark, can you go ahead and look at the legends box, circle the legends box. I like to look at the legends box real specifically because I look at what that cash flow per share is, and I have it later on to show you how I quote unquote do a quick and dirty asset or a discounted cash flow to see what the stock is worth related to its cash. Next slide. Okay, here we have the next half of the value line, and I like consistency in my stocks. So here we have our cash flow per share as you're looking across for the last, since like 2009, is consistently going up. So they generate quite a bit of cash. You have a, earnings are fairly consistent there. We've got a dividend stock. They keep raising the dividend. That's perfect. One of the other thing I like, if you look at the last, since 2015, they're keeping their capital spending per share pretty consistent. So they're keeping those, they're watching what their expenses are. As Buffett said, as Mark had talked about earlier, if you want to make sure you have a good company, you like to make sure your book value is going up per share. I am very much, I guess you could say that I always, a priority for me is to look at what the common number of shares outstanding is, because I want to make sure that the share count is not going up, because that as a shareholder is going to be detrimental for having to share any dividends with more members because we have more shares. So they've kept the share count down, and they have been buying back shares, because if you look in where Mark just drew it at 2009, it was 271 million shares, and now it's down to 205. So they've been buying back some shares, and that'll help the stock price as well. Now, you'll also look at where in 2021 to 13, they feel that the annual PE is going to be 16. Well, if our current PE is below 11, probably 8, 9, and they think it's going to go up to 16, obviously that's going to mean stock appreciation. It's going to let the stock price go on up. We've got consistency with sales going up. We have a very small operating margin, so we have to keep an eye on that. But, you know, our margins have been very consistent, so that's good. Our tax rate is 25%. We know that that's going to be coming down. That'll help. We do have, if you can see also where the next at the long-term debt, they've been, because they generate so much cash, they've been able to reduce that outstanding debt. And that's always wonderful, because we know interest rates are going to be going up. We know that the interest on their debt's going to be going up. So we know that they're, with all the cash that they have, they'll be able to pay off that debt with as much cash as they have. I like to make sure that my companies have a return on shareholders' equity. This means that these management people are great capital allocators. And if I'm giving my money and I'm buying a stock, I want to make sure the management team is able to allocate that capital to grow my money. Having over a 20% is perfect. So you remember that the George Nicholson always talked about the triple play. You want your P lower than the average. We have that. We've got room for the stock appreciation to go up, because the PE goes up, as we looked at when it was going to be currently on that value line sheet. It said 11. They think the actual PE will be going up to 16. That's going up 5 points. Obviously, the stock price is going to be going up. And our operating margin is consistent or growing. And we found that our operating margin, it may be tiny, but it is consistent. So this is also, I felt, a great candidate, because it does have that consistency, and it has that triple play possibility. Now, I did look over in the capital structure, and I recognize that it has long-term debt, and it has the interest due, and it has pension liabilities, but it generates so much cash. I'm not really concerned about that. Next slide. This is my quick and dirty DCF. We take the legend box from the value line, and it's 11 of cash flow per share. You took the cash flow per share of $26.70, and then you subtract out the dividends of $2.05. You subtract out the capital spending per share, because the company uses that to help grow the company. And obviously, I have the stock price. You take what that average out of $26.70, subtracting out $2.05, subtracting out $2.20, which added up off the top of my head, I think was $24.75. You multiply that times 11. That just by the discounted cash, fast and dirty discounted cash flow. That means that this stock should be relative to a value of $246. And if it just closed at $138.78, to go from $138 to $246, guess what? That's how our PE is going to expand, because the price is going to expand. Next slide. Value Line recognizes that there are strong finances in this company, and they've got ample cash flow. But considering how healthcare right now and what's going to happen and changing technology, we don't know what's going to happen. We know that the healthcare area right now in the market is kind of out of favor, and that makes me really like it more. And it's nice when Value Line kind of agrees with you that these quality shares offer strong 3 to 5 year recovery possibilities. So there you go. And I love it that we have financial strength of A++. Can't do any better than that. Next slide. In the manifest dashboard, I went and looked at this, and look at that. We have a par of 15.4. Our quality is 91. That's great. If you ever have to have a medicine, because they also distribute medicines to, it said hospitals, but pharmacies and independent pharmacies. So we all, I'm sure, are been on a prescription now and then. So somehow we all have had this stock probably touch us. It's a 4-star on the caps area, and we've got quality, and we've got our over 15% return. Next slide. And I always love to look at, how our quality is and all that. I think is pretty good there, Mexers. And I like it where the fools, you can't do too bad when you have 700 people believe it's an outperform and 30 an underperform. And of the all-stars on the monthly fool, 196 outperformance and 3 underperforms. You definitely have the odds in your favor. Next slide. And as I said, they are the distributor. That's what their core competency. They get the drugs from the manufacturer to the providers, the hospital, the pharmacist, so us as patients can have it. Next slide. And I know there's a lot of things going on in the market right now talking about the opioid crisis, and they've been addressing this in their PowerPoint presentations that they've been doing, talking about how they have their own opioid task force recommendations, and they're putting it out there of what they feel is the best thing to do, and they're not putting their head in the sand on it because they know this is going to affect them. So I hope you would consider McKesson as a stock for you to be interested in and be considering it for it as a purchase. Thank you so much for your time.
Okay, thank you, Kim. Yeah, and considering that Cy and I both recommended at higher levels, so if you're right, if we're right, you're even more right going forward. All right,
Great minds think alike.
Yep. I'm going to switch gears and talk about every week we put out stocks to study from the update batch, and this particular batch of 1/13 of the companies in Value Line. As I said on the cover slide, applied materials is kind of compelling up at the top. But what I'm looking for here is, again, with the average stock coming in around 7 or 8%, we're just looking for ones that have a margin of excellence or outperformance potential. And what I kind of like to see, I don't obsess over this, but I do kind of like to find a company that's got fairly decent agreement across the board. You can see that when you drop down to Acuity Brands, you've got decent return, decent quality, but you're also trading fairly close to the 52-week low. You've got a good long-term outlook from Value Line. Morningstar and S&P think it's on sale versus its fair value, and both the analyst consensus and Standard & Poor's think it's actually positioned pretty well for the next year, the next 52 weeks. So it basically is a slam across all of those conditions, and that attracts my attention to Acuity Brands. There's a couple other good ones on that list too. Universal Display, remember we talked about possibly walking away from it several months ago, and it's actually come back into a potential accumulation zone. Could actually show up here at the roundtable again in the future. What do these guys do? They make lights. They make commercial lights, industrial lights, utilities, residential. It's what they do. Big buildings, small buildings, houses, canister lights, lights on poles, lights on Buckingham fountains, etc. They've actually received some awards from the energy conservation end of the business, replacing the LED stuff with, or the traditional lights with LED-based technology, and it's what they do. One of the leading suppliers based out of Atlanta. Here's what they look like over the years. Again, fairly up straight and parallel. The stock price has languished for the last couple of years. That's due to concerns over market share and maybe a little bit of slowing of growth. And they have had some weak quarterly results fairly recently that hammered the stock price again. But again, with a long-term perspective and absent any horrific recession or bear market, you're looking at a company that's poised pretty well with respect to up straight and parallel going forward. Here's to show exactly kind of what happened to many of these companies. Cree Research was another, ticker symbol CREE. They shot up with all the expectations about the new light bulbs and the changing out and the technology and all that stuff, and PEs basically soared from 2012 to 2016. The stock price has kind of outpaced what was going on in reality, and we're basically seeing a correction back to reality. These guys have a strong long-term trend, and I think that they're just basically correcting back to where they need to be. The price action has been so pessimistic, it's actually driven it down into the oversold range with a relative strength index closer to 30. We'd like to see it down in there if we're trying to go shopping for companies that have been under duress. And it's actually down 30% over the last 52 weeks. Here's what it looks like in terms of some of the key assumptions that we make. Again, from a year ago to today, it's down some 30% from a little over 200 down into the 140s. But again, we're talking about a company that has continued during that entire stock price plateauing and downdraft. Those sales continue to go up. Again, not quite at the levels that they had seen historically, but for a mature player, industry leader, with upper single-digit growth rates, that's not exactly a crime. The sales growth forecast dropping from 13 to 9, I kind of look at that differently. I say in order to make that return forecast come true, they only have to achieve 9%. It's kind of like a low bar. And the projected net margin is expected to be in the 10 to 11 range, perhaps a slight uptick. They do get some benefit from the tax bill change with a slightly lower effective income tax rate. But you can see they're becoming more profitable. These are profitable technologies in the way that they deploy them in the construction business. And the PE ratio, again, swelled with some of that expectation stuff over the last 5 years. We would expect to see it settle into that 15 to 20 range. Under those conditions, we're talking about a fairly decent return. Again, with the average stock at 7 to 8, we're talking about a decent, mature industry leader somewhere in that 12 to 13% range for return, and a fairly attractive story for the long term. So we'll go ahead and add Acuity Brands to the tracking portfolio and turn it over to Mr. McManus to come back and revisit a little bit about General Electric. They also make light bulbs. At least they used to. Hugh, do we have you?
Yeah, I'm here. I just forgot I was on mute. So glad this is not an IQ test. Yeah, GE does make light bulbs, but maybe that'll not last very long. The light's gone out on that division, I think. So GE, as everyone knows, is kind of like a train wreck. Another train had crashed into it. Bit of a mess. And it's sad to see it. I've followed GE for years and I've never bought it. Gosh, must be 20 years now, more than that perhaps. I've always admired the company. It's a standout in that it has survived in the Dow Jones Industrial Average for over 100 years. It's often credited with being one of the original entries into the Dow. I'm not sure how accurate that is. I'm frankly concerned that it will not be in the Dow in the next 2-3 years, particularly if it splits up, and particularly if the current performance of the last couple of years continues. This president right with Pesco, then the bleeding could stop and GE could recover. We will see if it's better than a shadow of its former self. And we will see if the accusation which appear to be accurate, that there was a bit of shenanigans with financial reporting. To the extent that those are accurate, we'll see how this company survives. But this is kind of an unbelievable situation 10 years ago. This company looked like it was going on forever. Of course, we all know that all companies die, and you come. Are formed. So the restructuring, new CEO who took the helm on August 1st last year seems now to be righting the ship, at least in small steps. So if we move on to the next slide, you can see that it is a dollar component, as I mentioned. Here's the staggering news. It was worth 213 billion last August. It now has pretty much halved that in the last 3 to 4 months, and even in the last few days. Revenues are falling, earnings are unappealing, they are closing businesses, and they have accounting issues with the SEC. So what's not to love about this company? So let's keep going. And I was joking, you know, the song, "We Bring Good Things to Life." But yes, they have been bringing a lot of mood swings to investors and lots of strife to portfolios. So let's move on. I should have put a soundtrack on there. A part of this is stubbornness. I do think this company will turn itself around. That's why I want to buy it. And as Mark said earlier, if I was right when it was worth mid-20s, I should be even more right when it's half that value. I've gone on this journey. I've gone on a similar journey before that didn't end well. I don't know if any of you remember Nordic Track, which was available through what was then called NAIC. You could send a check every quarter, and they would reinvest in shares and reinvest. I'm not sure if it had stellar dividends, but you could buy shares on a quarterly basis. And you know, for quarter after quarter, I might be sending a $200 check at only 12, 14, and another quarter it was 16, and it jumped up to 22. I said, wow, this dollar cost average seems to be working. And then the next quarter after that was just over 7,000 shares. And the reason, of course, was that this company had engaged in shenanigans much worse than GE. They had actually violated patents. You get hammered 3 times your revenues for that. And so the company went under. It was this well-learned lesson. I don't think GE is going that way. I think management is saying the right things, and they're working to turn this ship around, and he's going to be really aggressive in the next few months. Let's move on. He being the CEO. First thing they did, which is what not to do 101, is to cut the dividend in half. That usually scares off a lot of investors, but still, this company has a better than average dividend yield, and it frankly didn't have the cash to support the dividend, so it had to do it, even though it was able to repatriate some monies overseas. The CEO has announced, I think, much more at least can tread water, not lose too badly. They're shifting away from underperforming businesses. Aviation, power, and healthcare are kind of the favorite things right now, but transportation and lighting is likely to be divested. And having said that, coal and gas are other areas that have been doing very, very poorly for the company. So who knows what will happen there. They've certainly ended a major, I'm drawing a blank right now on the name of the company, but they're getting out of a major alliance they had in the energy sector, which would have been a drag at GE. And they are going to reduce headcount substantially. Could be 15 to 20%. So let's move. So a lot of bad news, but these are signs that management is key. That full year of 2009, the stock price reached a low in early March of that year. It seems to be headed, albeit a little bit more slowly, in that general direction. But my thought is that this company is approaching a bottom, at least in terms of what the dividend can support. And it now depends upon management to turn things around, dig deeper into its existing company, existing customers with expanded product offerings. GE for too long has been more of a commodity supplier and not really gotten involved in the value add, let's say, Salesforce might do, or Microsoft, etc. But it's now, certainly in the medical area, getting more involved in the value add that it can give to its customers. So let's move on, and we can see here the Value Line Investment Survey. This is free because it's a Dow component, and this really illustrates where the problems are to some extent. I mean, you can see that the value line itself is declining. That's driven to a large extent by cash flow, and the cash flow is falling. The revenues as a result of the revenues are falling. As a result, the cash flow is falling, and the stock price follows suit as it should. The target that they have for this company is for it to double from its current position in the next 5 years up until 2022, so almost 6 years, in the 30 to 40 range. Nice if it did that from 13. I think when the next report comes up, they might edge those numbers down a bit, particularly based on what the CEO has been saying recently. But we're now at a price today, I think it was just over $13, that hasn't happened in 2009. Let's move. We can see some of the numbers from the Value Line Investment Survey. Keep in mind that this is the table that follows after the value line chart itself, and things are really shown here in revenues per share. So just keep that in mind. It's still not a good situation because the share base, as you can see from, if you scroll down about 6 points, you see common shares outstanding, and they have been on an aggressive share buyback, as we've talked about before, but the revenues per share have been pretty much stable. Cash flow per share has not been performing well. It's been cut in half. Some of that might be due to some of the assets that it's selling off, which makes sense. And the one thing that I really wanted to do but didn't have time to do on this company is to carve up the return on equity into its 3 drivers, 3 new drivers, just to see how GE is performing. I will do that, and I will.
Yeah, and just if I could just jump in for one quick comment here. We talk about share buybacks and whether or not they're good or bad. And if you actually take a look at the huge number of shares that they repurchased back in 2015 and 2016, they actually bought with the stock price several times above what it is now. So that's questionable.
Yeah, no question. They could have bought back twice as many shares today if they'd been.
Or three times as many.
And this is just a look at earnings versus estimates.
Mm-hmm.
Well, there's going to be a big racket now in a second, so the dog's going to start barking. So somebody just walked in, so you're going to hear a cacophony in a second.
Okay. For those of you that don't know.
Anyway, I just wanted to show what the earnings have been doing over the last number of quarters, and the estimates, which have actually been on track, which gives me confidence that some of the analysts, at least, who are getting a little bit bullish on this company, and there aren't too many of them, I have to admit, but they are leading indicators, shall we say, and so this might be a good trend. You can see on the second one where they show earnings and revenue. Earnings are paltry fraction of revenue, nothing like what they were in the 80s, 90s, and early 2000s, but still, as I said, my faith in this company is driven by the CEO and what he is doing. So let's move on to the next one. It's still owned by, I call this from Morningstar. There are 2 slides here. One shows funds and one shows institutions. But it's just to show you the number of shares that are held by these various institutions. Vanguard Total Stock Market Index holds 2.24%. You can see the group itself holds 7.07. So a huge percent of the outstanding shares of GE are held by a bad thing unless they all sell together. But we will see. I doubt they would. If we move on to the next slide, we can look at what's happening on manifest investing. Here we see the projected annual return is a very healthy, a little bit suspicious, 21.5%. The quality of the company is good, but not great compared to where it used to be. But this projected return gives me at least some solace. It's coming from a very low base. Excuse me. And we skip the next one, we can see the quality rating for this company. They're broken up. The total quality rating is 70, which is good, but maybe not great compared to where it used to be. And these numbers were obtained today with a price of 30.44 cents. And this may actually be changed significantly when the next, not significantly, but somewhat, I should say, when the next value line investment survey in GE is included. So let's skip to the next one, where we can see then after quality and the analysis, where we're just looking at top in the industry and top in diversified. So it doesn't really perform well with regard to quality, but certainly with a projected annual return, it's looking pretty good. Again, I don't know if that projected annual return will be toned down a little bit, but we'll see. And then moving on to the final one in this, we can see how the quality and the projected annual return have fared over time. And definitely the quality has started to deteriorate a little bit from where it was for many, many years, for quarters. But the projected annual return, well, it's declined a little bit too, but it's still pretty aggressive. So it gives me some comfort. So let's move. I think that is drawing to a close on YGE. There's a spelling mistake there, but it has weathered, past tense, a lot in the past. It's been around for over 100 years. Not that that's a recommendation for anyone, because otherwise you'd be investing buggy with companies. But it is in trouble. However, it seems to be doing the right things to right the ship. And so for me, at least, buying shares is a vote of confidence in management. It's not a vote of confidence in its current financial mess, I would call it a mess, or its issues with accounting practices. But if they faced up to that honestly and directly, I would predict this company will turn itself around. And then skipping to the last one, it's the same choice as before. So GE, let's hope it brings good things to life.
Okay, well, thanks, Hugh. Hugh and I were kind of kidding around. There's actually a fairly major news item that the rumor is that Warren Buffett's company is buying shares of General Electric, and that the stock price, I think, in after hours may have moved to as much as 5%. So Warren Buffett is getting on board with you, Hugh.
Well, that might help me get a vote in the poll.
Could be. All right, Ken, do you want to go ahead and take us to a poll? Ken, I think you may be muted. I'm not hearing you yet.
I am muted. I was trying to be good. Oh.
No,
Ken Kavula is being muted.
Ken Kavula is still muted.
There you go.
And again, we encourage everybody to vote. We're showing about 50 to 60% checking in already. Passing through 80%. We like to get 90% voter turnout here. We'll let it go for another 15 seconds or so. And I'm not sure why we've lost Ken.
I seem to be back on now. Am I back on now?
You're back.
Okay.
And we're coming up on your magic 90% here, Ken.
All right. Well, I'm going to close the poll in about 5 seconds. And it's not too often that we have a vote as close as this one is. Let me share the results. I think we have 42% for McKesson, 41% for Western Alliance, and a few scattered votes for Acuity Brands, GE, and none of the above. If it's okay with Kim, how about we put a position in both of these? Kim, is that okay with you?
Sounds perfect.
To the victors go the spoils.
And I'm going to close that poll. poll now and hide it.
Okay, we'll go ahead.
And Mark, you can move to the next slide then.
Yeah, before we go into our discussion and Q&A period, just wanted to make people aware of some of the upcoming opportunities. Ken and I are going to do a turnout Tuesday, which will expand on some of the stuff we're going to talk about here in a minute, a week from today, specifically the impact on stock analysis from some of the changes in tax laws and just the turbulence in the accounting arena. Ken and I will both be in Cincinnati/Dayton, Ohio, third weekend in April. Our next roundtable will be on April 24th. And then you can just read on from there. We'll be in places like Ann Arbor. All of us will be at the National Convention in Orlando, although I don't think Hugh can join us this year. But Cy will be there. And Ken's going to visit Oklahoma in August. Cy and I will both be in Atlanta in August. And Ken is going to be in Charlotte in October. So you'll hear more about those in coming months. But what I thought we would do is just kind of kick around for a minute just to show again, we talked about this last month and we've been talking about this topic at least from 35,000 feet, and anybody can chime in on this. The new tax laws are actually going to do things. In fact, in my presentation of Acuity, I didn't mention their effective tax rate for years has been 35%. It's expected to go down to 20 to 25%, and what that will do to earnings will be interesting. What you're looking at here is a look at the first 7 updates in the new year as we ratchet forward with the Value Line Investment Survey and the updates. And you're literally looking at the average company, industrial company. None of the banks are in here. So we're looking at the net margin for those. And you can see that on the right-hand side, the expectations for 2018 this year and then next year 2019 and 3 to 5 years out are fairly robustly expected to expand.
Yeah, Mark, the thing that I find that people are having trouble remembering is that not all the tax savings are necessarily going to flow to the bottom line. They're not necessarily going to move to earnings. If the company decides to put money into increased worker pay or to bonuses or something like that, that's not profit, and that's not going to move to the earnings per share line. So you have to be really careful in saying the tax rate's going to go down X, and all of that's going to increase earnings per share by X. It'll be a much more complicated equation than that, I think.
Absolutely. In some cases, they might actually reduce the top line prices in an attempt to sell more, be more competitive at the top line. Hugh or Kim, any thoughts on the issue facing us?
Well, Cy did ask me to remind everybody that this will play havoc with our analysis for the next 4 quarters. But once those 4 quarters get established and the companies decide what they're going to do with this, in many cases, this windfall, then we should see some consistency 5 and 6 and more quarters out as the companies start to do the same thing over and over again. Just like if we look backwards, we can see in most cases for most companies, we can see consistency or relative consistency in their tax percentages, their effective tax rates for 4, 5, 6, 7, 8, 9, 10 years. Going forward, we should start to see that consistency after we get through the first 4 quarters of the new tax law.
Yeah, and I think one of the things we'll be looking at in greater detail, especially next Tuesday, is companies like Apple and Microsoft prepared a little bit more than some of their contemporaries, setting aside some reserves to basically pay taxes up front for repatriation, and all of that stuff makes for a fairly tangled web. But again, just reinforcing what Cy had to say, some of this is going to be like the bulge going through the boa constrictor. Some of it's not, although it'll be there semi-permanent, some of it's going to be go through in the form of a lump or a bump for a couple of years. And that needs to be considered in a long-term perspective.
guess what we're doing is we're teasing our Turnout Tuesday. We're going to spend the entire Turnout Tuesday next Tuesday, 8:30 Eastern Time. If you need a registration link, send an email to myself or to Mark, and we'll make sure you have a link for that Turnout Tuesday. An email will be going out to our reminder list in the next day or so for Turnout Tuesday, so you'll be getting a reminder in the mail as well. But we're going to spend a lot of time talking about taxes and how you can factor them in, and why you have to be particularly wary of gap data, especially for the next 3 or 4 quarters.
Absolutely. The other thing we just wanted to take a moment to talk about, and if anybody has questions in the audience, please bring them and we'll try to address them. But we have seen, that 700-point down day on Friday, followed by a almost 700-point up day on Monday, and I think today we checked in at about a minus 400. I don't know about you, but I actually fielded phone calls for the first time that I can remember from friends that are investors that are just getting kind of worn out by this. And the volatility is something that we have forgotten a little bit. It's been so, if you look at these charts, we had this long period here where it seemed to be very not bumpy at all, and then the last unprecedented 12 or 15 months. But we have seen this before. Again, come back to we've seen this movie before. It is a rerun. As recently as the end of 2015, we actually had worse volatility. And then if you go back to the bear market that happened back in 2008, 2009, that was definitely worse. So it's not unprecedented. And again, to Sai's point, keep in mind, this is a point that we like to make when we do our educational sessions around the country, that what you're looking at right here, this beast right here, was the worst performance or the worst period in stock market history. And it was a very difficult time. But in the context of a true long-term perspective, it's actually becoming a blip, believe it or not. And it wasn't easy back then. I'm not pretending that it was easy, but in the context of keep your head down, we don't invest in markets, we invest in stocks. We find great companies, we buy them when they're on sale, and we just keep doing that. And you can avoid some of that bump, but again, the volatility is real, and I've had to talk a few people into not cashing out because they're getting tired. It can actually get very fatiguing to try to be an investor through this type of volatility. Any thoughts or comments from anyone?
Well, I have a comment, Mark. I've taken to turning my television off. I think that a lot of times, if you're already a little bit apprehensive, listening to a 24/7 news cycle about what's going on when everybody has different opinions and nobody really knows the correct answer, I think can be damaging to your psychological health. It's amazing how much happier I feel when the TV's not on, and maybe I should be like Mr. Buffett, who claims to only look at his holdings occasionally, not on a regular basis.
Yeah, I view CNBC as kind of the financial pornography channel. But, the thing is, I remember when I started looking at SSGs back, I guess, in the early 90s. At that time, the teachers would always go all the way back to 1987 and talk about, what happened then, this is not typical, et cetera, et cetera. But as Mark pointed out, the blip disappears over time. There was a time when you just had to look at a stock price chart. You could identify 1987 immediately. But 15 years later, you actually had to start going and looking at the numbers, the dates, the year, to see where exactly did 1987 fall. Oh, it was that little bump there. What seems to be a disaster at the time turns out to be noise. And actually, if you go on YouTube, Louis Rukeyser, if you look at the crash of 87 and put look for Louis Rukeyser, the entire show is on there in 3 segments. The Friday before, when he had a panelist who projected that it's going to be a bloodbath on Monday. So the Friday after, when he had some very, very, I think, did he have Templeton on there? I can't remember, but he had some very key people.
Yeah, I think Mario was probably there, and
yeah. Well, they're calming nerves. It's a very good show.
Yeah, and the lady from oh geez, I'm forgetting her. Mary Farrell. She was actually very calming back in that time frame. I'll have to dig up that.
Mark, go on, Mark. Yeah.
I was just gonna say we'll dig up and share the Rukeyser. Hugh has actually shared several of those segments over the years at Manifest Investing, so we'll dig them up and share them. They're fun to watch, and it's just completely reinforcing.
Well, we don't seem to have a lot of panic, at least in our questions here. So let's move to some of our questions from the audience. Okay. Barb would like to know, do any of us really do anything with Dow theory? That's met with deafening silence.
I love Chuck Carlson and I read his stuff.
Barb, I think the answer is I think the answer is that we don't we don't hold Dow theory out as one of the chief mobilizers of our portfolios. It's not something we really deal with on a fairly regular basis. I think the four of us are pretty dyed-in-the-wool conservative growth at a reasonable price investors, and that doesn't always fit with some of the more technical theories that are propounded. Miriam would like to know, can somebody explain how to get info on Morningstar? Is it free? I think you need to understand, Miriam, that Morningstar data is what you're receiving from Better Investing. And then I think at most libraries, you should be able to access Morningstar electronically. I also think if you just type in morningstar.com, you get a pretty decent, albeit a truncated version of Morningstar, and that'll be plenty to get you started, at least if you're looking for various things. The best place, however, to get a full subscription, try your local library. You'll be surprised at what they have electronically, and we have found traveling around the country that most libraries do carry Morningstar as a free electronic subscription for their patrons. James wants to know, in future polls, could we add more information to the names of the stock? James, we have extremely short numbers of characters we can put into a poll. We can't exceed X number of characters, and sometimes I have to really be creative just to get the full name of the company and the ticker into the poll. So I would suggest that if you're really taking the poll seriously, that you try to include those numbers as we present them. Most of the time, any one of us that is making a presentation will give you a manifest par number and a manifest quality number. And if we miss it in a particular presentation, then ask a question and we'll make sure that you know what it is. But we can't get them attached to the polls, at least not to a lot of the companies, because of the limit on number of characters that we're dealing with. Bonnie, there's a series of questions coming from you, but I'm suggesting that they've been cut off, or you didn't type them so that they got sent correctly, because 3 of the questions are just not legible. So I'm going to ask you to resend your questions, whatever they are, and I'll try to make sure that we get them answered before we sign off. Kay, I'm having some of the same problems with your question. Your comment starts out, TDOC looks very promising theoretically. I'm not sure what TDOC is. Maybe you can clarify that in a further question here, and then we can speak about it. Marty says, a bad time to sell when the market is down. Mark, you want to react to that? Marty's usually pretty spot on when it comes to dealing with stocks and portfolios.
Well, yeah, it just comes back to, if the stock market has dropped a couple thousand points and you sell after it drops, it's like it's like going into a store and refusing to buy the stuff that's really on sale. And literally, you've got situations, what we're looking at here is the Morningstar page for McKesson that Kim presented tonight. And the current price is somewhere down around $140. Well, according to their analysts, and their analysts are very much like SSGs, they think a good fair price for McKesson is $210. So they think it's literally on sale for $70 off. So why would you sell it at $140? Especially if you bought it at $180 a couple weeks ago. Unless you saw structural issues with the company. And again, no, if the return forecast is ramping up like you see on our chronicles, it'll take you in the right direction.
Miriam has clarified what she was asking about Morningstar. Miriam wanted to know where could she find where the different mutual funds own these stocks. And Miriam, that's all part of the Morningstar site. You can go to a particular mutual fund and find out what its holdings are, but you can also go to a particular stock and find out what the ownership happens to be. And Mark's kind of demoing that right now on your screen as you look. He's put in McKesson, and then he's gone to the ownership tab. And Mark, why don't you finish that explanation, because it's being hidden by my questions box here.
Yeah, in the case of McKesson, you can actually look at the institutions which hold the company. Wellington, which has a very strong track record over time. Vanguard, again, very, very stable. BlackRock, one of the biggest asset managers in the world. State Street, that's a lot of custodial type money. And a lot of times if you go to look at the type of companies that are holding an individual stock, you get a feel for the stability of the situation. You might go to a company like, let's just go to NVIDIA, which, by the way, was down 12% today. Same situation. When you go into their institutional holdings, you'll generally find companies that they might be too big for this. A lot of times you'll find companies that are a lot more eager to turn over. And Fidelity is one of those, by the way. Fidelity will turn over faster than the average asset manager. So you can actually take a look at the ownership behind the scenes.
Mark, Miriam has clarified a little bit what she was talking about, and basically I think you've answered her question right now. Kay is asking about teledocs, and the crux of the question is, can a company appreciate in value without corresponding earnings? I think those are vocabulary words you have to be real careful with.
Yeah, I'm still not completely clear about teledocs. Is that a company or is it a theme? I'm not sure yet. You can.
We're going to need a little bit more information, Kay, as to what teledocs happens to be. But I can tell you that over time, if a company doesn't have any earnings, eventually it doesn't have any stock price attached to it. Now that might take a period of time if there's angels supporting the financial structure of the company, if there's capital flowing in from other sources. But eventually, a company that doesn't earn will not have a stock price. The company will go out of business.
Yeah, and perhaps Hugh can speak to like a biotech can operate for years without earnings, but they're literally trading on future promise and
that's the
potential.
I view the stock market as a huge argument, right? Really.
Hugh, we're having
will be or could be.
Hugh, we're having a great deal of difficulty with your sound. You're cutting in and out quite a bit. So say that again,
okay.
Would you please?
Well,
it's too bad.
I view the stock market really. I can't be heard.
You're cutting in and out, if you can hear me.
Okay.
So we might have to come back to the thought.
No, it's not working. So I can hear you guys perfect.
Yeah, we're having some trouble with your sound. Mark K is trying to explain that Teladoc is a company that enables sick people to access a doctor over the phone.
Oh, well, yeah, I think that's an area of certainly worthy study. Yeah, all of the telemetry stuff, the technology, the Internet of Things type components in the healthcare arena are definitely worthy in terms of thinking about the long-term trends and the opportunities there. No doubt about it.
We have one comment from Leslie that says she was at a money show recently and a presenter commented that value line is too subjective. Any thoughts on that remark? Mark, you're a great proponent of value line, as am I. You want to take that remark?
They're too subjective. Well, I'll tell you what, I would just take it back to how right are they? How correct are they? And they certainly rank very highly amongst the, if you take a look at their overall track record, it's actually quite strong. And that's where the rubber meets the road. You build a portfolio using value line stuff, and whether it performs or doesn't perform versus anything else you would measure it against, they have a very, very strong long-term track record. The one area that they do struggle, and so do we, is with early stage investing. They do have trouble with that a little bit.
I would just remark that's the nature of an analyst, to be subjective. When you do an analysis, you're being subjective, and exactly as you said, the proof isn't in how subjective you are. The proof is in how close to reality do your analyses come. Are you coming up with numbers that make sense and that are true to what actually happens in the future, or are you way off in left field somewhere? And I think that's the nature of the beast, is to be subjective.
Yeah, I think it's time to air out that performance again, and I think I will do that here very soon.
I've cleared the question box. I see I have a hand raised right here. Let me see if I can. Nope, the hand went down. It was an inadvertent hand. So we'd like to thank everybody for coming this evening. It's great to have Hugh back again. We'll have to work on that sound before the next time and see what's going on. Hugh, it almost sounded like you have a short. Are you using a headset?
No, I'm not, but I will next time. I'll put a headset in.
Maybe that was it. Maybe it's just something.
Yeah.
Okay, but thank you all for coming, and if you are going to want to talk about taxes next Tuesday, Mark and I are going to spend an hour and 15 minutes talking about the new tax law and some of our thoughts about that whole process. We promise not to take a real deep dive, but we promise to do more than just skim the surface as well. Guys, especially Kim, thanks for stepping in at the last moment. We really appreciate it. Hugh, whenever you're here, we appreciate you. And Mark, you're always appreciated. Thanks for coming again. And we'll talk to everybody in a week or in a month.
Yep. Happy
Good night, everybody.
And Passover, and everybody have a great holiday.
Thank you. Good night.